We're going to get started with the last panel of the day. Always nice to be the people between you and a drink. Before we get started, I'll just do a couple of quick housekeeping matters. We, of course, will welcome audience questions, and we will build in time to respond to them. Now, having said that, as many other moderators have said, we may run out of time and may not be able to answer every question. So we will commit that if you provide your email address, we will get back to you by email with the response. So with that, allow me to introduce the panel, the last panel of the day. My name is Samir Sabrawal. I'm the Executive Director at the Alberta Securities Commission. To my immediate left is Denise Weirs. She's the Director of Corporate Finance. To her left is Hilary McMeekin, who's the Director of Communications and Investor Education. And to her left is Cynthia Campbell, our Director of Enforcement. Today's panel, or the last panel, is the ASC Fostering a Thriving Capital Market. And if you'll just let me set a bit of a foundation for our discussion, I think it'll be helpful. We've heard some excellent discussions earlier in the day, particularly talking about the challenges we face in the country, the need to be bold, and the need to believe in ourselves and invest in ourselves. The opportunity to leverage innovation, how Alberta is poised to take advantage of the moment, and interesting insights about the investor experience now and going forward. As I said, this panel discussion will focus on fostering a thriving capital market. The foundations of our mandate at the ASC are to foster a fair and efficient capital market and to protect investors. A thriving capital market is dependent upon success in both of those areas. They're often pitched as being on opposing ends of the spectrum. I don't believe they are, and perhaps you'll let me explain. An efficient capital market depends on low levels of friction in the process of getting capital from those who have it and are looking to invest it to those who need capital to start and grow a business. It also requires a liquid secondary market with robust participation. A fair capital market depends on transparency and access to information and consistent enforcement of rules against misconduct that are designed to protect market participants. Now, there's an obvious link between the two. When market fairness is negatively impacted by bad actors, it reduces trust in market integrity and deters investors from participating in capital markets. When investors are deterred from participating, that increases friction and introduces barriers in the process of capital getting from investors to those businesses that need capital. So during this panel discussion, we'll be focusing on those two connected concepts by discussing three specific components of the ASC's work. Creating conditions that improve the ability for capital to flow from investors to businesses, with a particular focus on Canadian businesses. Deploying information that encourages investors' understanding of and trust in capital markets, and disrupting investment-related misconduct and taking enforcement action to deter that misconduct, to reduce harm to investors, and to maintain market integrity. So with that context, Denise, I'm going to turn to you first, and I'm going to ask you if you can talk a little bit about the work that we're doing to increase the competitiveness of the Canadian capital market and to help reduce the burden of being a public company.
Okay. Thanks, Samir, and thanks to all of you for sticking around. First, there's lots of different things that we're working on to try and address that. I'm going to focus on two, given the limited time we have. One is local in nature and sort of low key, but I think still important. And the other is sort of a late breaking announcement. So on the local matter, wanted to just highlight that as one of the things we can do to try and be competitive and to try and reduce frictions, I think in addition to looking at can we change the rules, we can also use education as a way to help reduce friction. So within corporate finance, we in early summer rolled out a number of new videos that help explain some of the disclosure obligations for companies that are public, how to file reports of exempt distribution, how to make applications to us. And we've got another batch of videos that we're hoping to roll out by the end of the year with the assistance of Hilary's team. And really the thought there, some of those later videos are going to deal with things like insider reporting, how to do that, how to make applications to revoke cease trade orders. So the thought there was really that we wanted to be able to provide a resource for companies that are maybe newly public, companies that are considering to go public. And as we see fewer and fewer companies being public, there's fewer opportunities for those young lawyers, those young accountants, those investment dealers to get that exposure. And so we thought that that could be a helpful resource for them. So that's available on our website in a new section called the Issuer and Insider Toolkit section. But on the late breaking news this morning, as part of that spirit of trying to make sure we have right-sized regulation and that we're really looking at whether we have a competitive capital market, the securities regulators across Canada announced a proposed new exemption. It's out for comment for 60 days, and the proposal would allow companies that are listed on the TSX Venture Exchange or the Canadian Securities Exchange to report semi-annually rather than quarterly. So that would be available to companies with annual revenues of not more than $10 million and that have been reporting for at least 12 months. It's conceived of as a pilot project, a 5-year pilot. We're adopting it potentially by way of a blanket order. A blanket order allows us to move much more quickly and be more nimble. So that could be in place as early as first quarter of 2026 if everything goes smoothly. It also allows us to be flexible and make sure we've got the right balance. Just as background, the ASC's advocated, I think, multiple times over the years for, to consider semi-annual reporting for these smaller companies. And it might seem sort of like a radical idea, but if you look at it from an international context, the UK, the EU, Australia, Hong Kong, they all allow semi-annual reporting. So it seems maybe more of a big adjustment when we, next door to the US, where they've had quarterly reporting. We've published proposals in the past seeking comment on this, and I think we did that in 2011, 2017, and 2021. The feedback has been, sort of quite a range. We've heard people who are quite supportive and think that it's going to help reduce burden for those smaller companies. We've heard feedback that it could help with, ensuring that the focus is more long-term and not short-term. But we've also heard from investors who aren't, necessarily comfortable with it and do want that information. So we're, definitely interested in getting feedback on it. But I think the sentiment is changing as people are looking at ways that we can try to be more competitive. And if the feedback from both the TSX Venture and the CSE has been supportive of looking at, allowing this type of an accommodation for the venture issuers. In the past, when we've looked at it, we've really kept our focus on the venture market, and we haven't looked at applying it to the senior issuers. Most of our senior issuers are raising money in the US, and part of that assessment is that they're subject to a comparable regime here in Canada, and we didn't want to do anything to disrupt that. Of course, we're seeing big changes in the US. Also, President Trump has tweeted that he thinks they should have semi-annual reporting in the US. And then the chair of the SEC has similarly said that they are seriously looking at that there. So if the SEC is to do something like that, that obviously will be an important consideration for us in determining what it looks like here in Canada. So we encourage you to have a look at the proposal. It's out for comment until December 22nd, and we would really like you to weigh in. But I am impatient and I don't want to wait until December 22nd. So we are going to ask you right now to have, we're going to have the Slido survey and Slido poll and have you weigh in and tell us what you think of this idea. There we go. There it is. Okay, so as outlined, the CSA has proposed a pilot to allow eligible venture issuers to voluntarily adopt semi-annual financial reporting. If adopted, those listed on the TSX Venture Exchange or the CSE with revenues, annual revenues of no more than $10 million could opt not to file their first and third quarter financial statements and MD&A. Do you like this idea? Does it strike the right balance? And so your options: no, I don't like it. Qualified support, you think it's a good idea, look at expanding later, or whether you think we should be expanding it now to include all venture issuers, or should we be looking at expanding it to all reporting issuers, all public companies, not just the junior venture issuers. So let's see, where are we right now?
Yeah.
We have
50%.
most are saying they like our measured approach. It looks like 48, 44. But second place, we got is looking at it should apply to all reporting issuers. Okay. And can I see? I'm not sure if I see that. Is the first number 5%? Yeah, 5%. The decimals are throwing me off. Okay, so you give people. Are we getting any more answers? It seems like it's pretty stable.
I think so.
Give people another couple seconds. All right, so close to half say yes, it's a good idea. Measured approach, we can assess later whether to expand. About a quarter of the room is saying it should be available as an option for all reporting issuers. Less than 5% are saying no, don't do it at all. And we've got 17% with qualified support think that there should probably be some information quarterly available. And 6.3 with expanding it to all venture issuers. So, okay.
Great feedback.
It's interesting because, you know, that's 3/4 think we've gone at least far enough or should go further, which is, I think, an interesting point to take back.
It is.
And of course, it's, as you said, it's been published for comment, so there'll be an opportunity for people to read it, ingest it, and then provide a comment letter, which of course we encourage everyone to do. If you want to weigh in on this, that's the best way for us at the ASC and for the CSA to judge the validity of regulatory positions that we take and how it might impact the market. So Denise, we heard a lot earlier today about the importance of capital formation. The moment we find ourselves in, even before this, it was important for capital formation. We now know that it's fundamental, critical. You can apply any, we heard the word crisis thrown around. We heard that this is a fundamental problem in Canada that's existed for a long time, and that the only way to solve it is to pull ourselves up by our own bootstraps, invest Canadian, get access to investment in Canada. What are we doing to address capital formation?
Okay. There are, again, a number of different initiatives that we're working on, but I want to start with quickly a story about a woman named Emily Kapashukowitz. Don't know if I can pronounce. That's her actual name. Anyway, she holds a BA in economics. She has a Master's of Science in Applied Economics. She's got professional experience with financial modeling, financial analysis, strategic planning. And Emily has a sort of a history, a professional history working in the health services space. She wants to invest in a venture capital firm that is raising money for companies in the healthcare space, developing medical devices, digital health platforms, and such. Emily lives in Texas, and in Texas in the U.S., just like in Canada, if you're going to invest, the idea is that you invest in with a prospectus or in the secondary market for public companies that are providing that information that you need in order to make an informed investment decision. Emily wants to invest in the private markets where that information is not necessarily available. So in the U.S., they have similar tests to what we have with that institutions can invest and individuals can invest if they meet certain income or asset thresholds. The theory is that if they meet those thresholds, that they have the sophistication to invest, or they have the ability to get advice about investing, and that they have the ability to withstand the loss of their investment. Unfortunately for Emily, she does not meet the criteria to be an accredited investor to invest. Her income is slightly below the $200,000. Her net worth is $850,000, which also doesn't meet the threshold. So what is Emily doing? She is suing the SEC. She and the venture capital firm are suing them claiming that net worth and income are not appropriate proxies for sophistication. And the opening paragraph of their suit states, while anyone can place bets on sports, go Blue Jays, or play poker for money from their phone, the accredited investor rule effectively excludes the vast majority of people from accessing private investment opportunities. And she expresses particular concern that given the declining number of public companies, there's fewer opportunities. Well, Emily, maybe y'all should look at what we're doing up here in Canada. So as you may recall from prior ASC Connects, back in 2021, Alberta and our friends in Saskatchewan, we adopted what's called the self-certified investor exemption to allow those people who don't meet the definition of an accredited investor to invest alongside accredited investors. A little more than a year later, Ontario adopted a similar but different exemption, and then in 2024, Manitoba did, followed Alberta and Saskatchewan. One of the things we heard was one of the biggest barriers was the fact that it wasn't harmonized across Canada. So on September 25th, the CSA, all of the CSA jurisdictions other than BC and Quebec, have published for comment a proposed instrument that would have a harmonized new self-certified investor exemption. But we haven't just harmonized it. We've also looked at the feedback that we've heard and tried to look at ways we could reduce the frictions that were identified with that exemption. So some of the proposals that are out there for comment right now would increase the amount that a self-certified investor could invest up from $30,000 to $50,000 per year. Also revisited the types of qualifications that a person could have to be a self-certified investor. The current exemption pretty much uses accreditations like a CFA, a CPA, a securities lawyer, an MBA. The proposal asks whether we should expand that to include people with professional experience, managerial experience, operational experience in the industry in which the business that they want to invest is operating. And we also, with the proposed exemption, there's risk warnings, and there's also some educational information to help people understand what kind of questions they should be investing or should be asking when they're investing in these early stage companies. So that's one of the things. I'd quickly mention a few others. Tanya Fleming, our manager of private markets and innovation. Hey, Tanya. She's been all over the province, Red Deer, Medicine Hat, Grand Prairie. She's attending tech events, agriculture events, co-op events, talking about how to raise money, how small business can raise money under exemptions. And that kind of goes with that whole theme about education and trying to reduce barriers by providing people with information and also hopefully improve compliance. A few other things to mention. One is for our largest companies in Canada, on August 28th, we announced the adoption of the well-known seasoned issuer exemption, which allows those largest companies that tend to go to market using a prospectus, a shelf prospectus, to let them do that without any review by securities regulators. And that should allow them to raise money more efficiently and with less uncertainty. That, subject to ministerial approval, should be effective on November 28th. And then the last one I'll mention is the listed issuer financing exemption. So back in late 2022, November, the CSA adopted the listed issuer financing exemption, and it was really targeted at the smaller end of the market and allows them to raise money with a very abbreviated offering document relying on their continuous disclosure. The securities they issue are free trading, so like a prospectus, but without the prospectus level disclosure and without the securities regulator review. In May, as part of the CSA's efforts to be more competitive, we issued blanket orders to expand the listed issuer financing exemption. So at the time that we were looking at the blanket orders, there'd been $1 billion raised under the life exemption since November 2022. We adopted the expanded exemption in May, increasing the amounts that companies could raise up to the greater of $25 million. Or 20% of market capitalization up to a max of $50 million. We're today, I'm told, we're at $2.7 billion since May, so a big increase. So that is a great news story. For us in Alberta, it we still have room to grow and to take greater advantage of that exemption. So one of the reasons I'm mentioning it here, in Alberta, I think we've had 128 million. So not our share. The majority of the funds raised have been in BC, and the majority, the great predominance of the companies raising money are in the exploration, the mineral exploration space. And if you look at the list, mostly gold. So it's definitely definitely an attractive option in that space. I think as we look at codifying the exemption and making it permanent, we're also looking at ways to enhance it further, and hopefully there are ways to make it attractive to other industries.
That was impressive, Denise. That was a lot of information you downloaded for the group, so thank you. I'm going to turn to Cynthia and Hillary now, because I want to turn our focus now to the investor side. And I'll start with talking about maybe the bigger picture about investors. We heard lots of conversation on the Focus on Investors panel earlier today about the importance of investors being engaged, being met where they're at, offering them multiple channels through which to invest that fits their needs, but the risk of fraud and the risk of misconduct that they're facing, particularly in light of some of the technology advancements that are perhaps being utilized in ways that are unfortunate and weren't anticipated. So maybe I'll start with you first, Cynthia. What is your team seeing with regards to fraud and misconduct?
Sure. Thanks, Samir. And I'm so excited when we get to talk about enforcement. Sorry. I want to tell you, we are seeing staggering amounts of losses happening from securities misconduct. And if I were to, when I thought about how do I categorize this all collectively of what we're seeing now are investment illusions. These are deceptions where people think they're being led to believe that there's a financial reality that isn't. It's deceptive. The reality is very different from what's actually being portrayed to investors. And these aren't simply psychological tricks. These are carefully crafted schemes that exploit trust, technology, and human behavior to get people to put their money into either fraudulent or inappropriate investments. And this is happening at incredibly serious levels. I think the throne speech today is so timely in terms of talking about threats to our economy. This is a threat, in my opinion, to our economy based on the scale at which we're seeing things happen. So I'm hoping we'll have time on the panel today. I want to share some stories about what we're seeing and what we're doing, cases that we have. But first, I do want to start out by making three really key points for the room. The first is that the scale and speed with which misconduct is occurring is like nothing we've ever seen before. And I say that even compared to sitting here a year ago. The scale and speed have increased enormously, and it's accelerating. It's an upward trajectory. Second point is these investment illusions are becoming more prevalent, more sophisticated, and harder to detect. They're hard for my trained investigators to detect who do this all day, every day, and go out there and find them. They're becoming almost impossible for the average person to detect and decipher from reality. And the third, as I mentioned a moment ago, is the harm. The harm that's being caused from these investment illusions, these schemes, is enormous. That harm is at a personal, individual level, the financial loss, as well as other forms of devastation these schemes bring on people, as well as the harm to our economy and the deprivation of funds for otherwise available for our capital market. So given these three factors I've just outlined, I think it's really important for every one of us here in this room to recognize that we each have a role to play. And I said, it's getting hard for people to decipher, so you might sit there going, well, she just said, how are we supposed to tell? There's a role for every one of us to play in whatever role we have as regulators, as government, as issuers, registrants, other folks working in industry, advisors, exchanges, as investors, as family members, as friends, and as good neighbors. We all have a role to play in raising awareness and in doing what we can within our own sphere to put a stop to it. because I can tell you this, there's no one agency or one area that is going to be able to tackle this. It relies on all of us upping our game to rise to the challenge that we're seeing right now in terms of the scale of fraud. The bad actors are getting increasingly effective at luring people into these investment illusions and parting people from their money. And that's only going to get more, it's only going to get worse. They would say better, I would say worse, given the prospects with technology and AI. And as I mentioned, investors, it's hard for people to decipher the illusions from reality, and people are being bombarded with investment illusions all the time. When I say people, I mean all of us. You may not know it, all the different ways in which these schemes are targeting you right now, but I can assure you we're all being targeted. So with that in mind, and thinking about investors today and how they're being approached, targeted by these schemes, Hilary, can you talk to us about what we know? We heard a bit earlier today about who investors are today, but your team does a whole lot of work in this area.
Absolutely. And I'm wondering if we could actually go to the next poll question, if you don't mind. Gentlemen, thank you. Where do you think that investors get their investing information from? I wanted to get a sense from all of you what you thought before I talk about it. And it's, of course, building on the fabulous panel earlier today. The options are a financial advisor, friends and family, social media, online chat rooms, online communication channels, just to differentiate, and other. It looks like you're all on track. You get it. Social media is, unfortunately, or fortunately, because Blair said it so wisely earlier today, it's an easy place to go. It's 24/7. It's accessible to you, and more importantly than anything we've said today, it's in plain language. It makes sense. It isn't something you're trying to decipher when you may or may not be confident. You may or may not understand the language. I couldn't agree with Andy and others earlier more. Financial literacy, investment literacy is so critical today. What we know is that over 82% of young investors are using social media as their go-to source of information. Over 53%, this is from a CSA study. By the way, I just have to shout out to the CSA, CIRO, Fair Canada, CIMA. There's a number of organizations, including the ASC, who are doing outstanding research to really get an understanding of what investors are thinking, what they're thinking and what motivates them, and so that we have a better understanding and we can hopefully reach them, communicate with them where they're at, because that's what's most critical. These are people who are moving fast. Yes, they may respect balance in life more than we do at this age, but they move fast and they want information fast. There's a saying, TLDR. In fact, I think it's the name of Wealthsimple's website, or newsletter. But it's too long, don't read. So that's the model, right? That's where people are at today. They don't have enough time to decipher a whole bunch of information. Yes, we know that just under 50% of people are trying DIY or self-directed accounts. And we also know that over 61%, according to the CSA study, still use advisors. So there's some hybrid investors, as Lynn talked about earlier. And some of them discuss their full investment activities with their advisor, some don't. Some just do DIY or self-directed. In our own qualitative research that we did, we wanted to dig into what motivates someone to do the self-directed route other than the things that we've talked about. And what we learned was two things. One, they're either self-starters, so they've had some mentoring in their life and they have some confidence, and they want to do it themselves, kind of like what Blair was saying. They want to try it out themselves before they get to a stage where they want to work with an advisor. But the other side of the equation are people who are too embarrassed and don't have confidence, and they know that they don't have enough money, or they believe they don't have enough money to warrant having an advisor. But they know they need to raise money, or they need to save money and they want to invest because they want to buy a home. We heard earlier today about people, it's harder and harder to buy homes, cost of living. So they're trying to find different ways. So they're looking for any avenue possible. And the last point I want to make before I turn it back to you, I know we're short on time, is almost in every study, people say they're confident, they know what the red flags of fraud are. They know how to protect themselves from fraud. And yet, in 2024, $310 million was lost to investment fraud alone, according to the Canadian Anti-Fraud Centre. So despite the fact that people feel confident, they're still getting hooked in by these illusions, by people who are professional at hooking them in and pulling them in and unfortunately bringing them along. So we know that there's a huge opportunity, there's a huge need to work together, like what you said, Andy. We know that we want to work together. So I'll pause there.
Maybe.
I think it's important, you talked about, both of you, the risks, the investor behavior. One of the things that we often kind of gloss over, but I think it's really worth thinking about, is that's lost money to the capital market.
Yes.
So money that's diverted through fraud is money that can't be invested in legitimate businesses. So everybody in the room has an interest from this, whether you're an investor, whether you're a family member, whether it's your own financial security, whether you're an employee. All of us should care about this, because if we're talking about the financial security of Canadians, the losses are bad from an investor perspective, but they're bad for businesses too. That's lost capital. So I think it's really important to remember that there is a dual effect, a dual negative effect that flows from this kind of behavior. I think you were going to take it on and talk to us about, in light of that, some of the disruption.
Yes, thanks. So, and perhaps I'll start by saying that the number Hillary mentioned from the Canadian Anti-Fraud Centre, the $310 million in investment losses last year, is really only one small piece of the total investment fraud pie. The explanation for why my numbers may differ from what they put out takes too long for here. Come talk to me after if you want, but truly the numbers are billions of dollars a year flowing out of Canada and out of Canadians' pockets into investment fraud. And the Canadian Anti-Fraud Centre acknowledges that as well. They indicate that their stats really are about 5 to 10% of all fraud. So once the frauds and the schemes happen, in almost all situations, the money is gone. And that money is gone from the individuals, and it's gone from our capital markets and our economy. So part of our objective is to get out there and to disrupt the misconduct, to interrupt it, to take that illusion and break it while it's in progress, hopefully prevent it, and if not, break it while it's in progress. And what we do in disruption, it's quite different than our traditional investigations. With disruption, we're focused on being fast, flexible, and minimizing damage. That's our goal. And we have a variety of means that we use to achieve that. But one of the things that's very consistent with disruption is we are almost always engaging with other partners. Because whether it's our CSA colleagues, police partners, industry, we need to tap into whoever is going to be able to help us be effective in stopping that particular misconduct. And it really varies depending what's going on. But I want to say collaboration is absolutely critical to modern enforcement. Okay, so I've told you what disruption is, but let me give you a little story that illustrates disruption in action for us from earlier this year. In March, we at the ASC were contacted about a website called CanCap that was purporting to offer it was purporting to be the Alberta government was offering CanCap crypto trading investments through this platform. Now, of course, that wasn't true, but this information came to us. And one of the things that really jumped out to us, because I'll tell you, there are literally thousands of crypto investment scam websites out there right now. But what struck us about CanCap in particular, and the information we received, is that we learned that it was we believed it was targeting Albertans specifically because it said this was backed by the government of Alberta. And so we jumped on it, and our investigators quickly started looking at the day that we got this information. And very quickly pulled together. There are at least 6 related websites to the CanCap one. There's also a fake CBC News article. If we can show that. It looks quite legitimate to those who go onto a CBC website, but there's a fake CBC News article that was a Government of Canada is also launching this. So the ASC immediately put out a news release called an investor alert to warn the public about this scam and to give the information that we had available at that time to the public to help people protect themselves. We also put the websites onto what we call our investment caution list, which is an online resource that we have at the ASC as well as at the CSA that identifies websites and other entities that are of known concern to us. But we didn't stop there. Sorry. No, it's fine. We launched what we call Operation CanCap, and we involved other agencies, other organizations to participate with us because our investigators felt there's likely more to this. We want to keep digging. And so we brought in the Calgary Police Service. We brought in Chain Analysis, which is a blockchain data platform. Thanks. And NDAX, a registered crypto trading platform. And that group of people got together and started sharing the information known amongst us. And together, they determined that this was indeed a very sophisticated and large-scale scheme that was specifically targeting Albertans and Canadians. And just give you a little idea of how large this scheme was. There were more than 5,000 online landing pages related to CanCap. So I showed you the one website earlier that had CanCap on it. Maybe we can put up the other slide. Here's an example of a different website. You'll see in a moment. That looks nothing like the first one, doesn't say CanCap. You wouldn't know looking at it, it's related. But we identified more than 5,000 landing pages online, different ways for people to get to this scheme. There are more than 1,000 crypto wallet addresses tied into this scheme, 11 international bank accounts where the funds were to flow through ultimately. And from what we could see, more than $300 million had flown into this one scheme. So the team also learned that there were a lot of fake crypto investment websites under CanCap and a whole bunch of other names all set up. In the early moments, they found 6. When they started digging further, they found a lot. To date, more than 1,160 scam websites have been taken down. They're offline because of the work that our team did on Operation CanCap. If someone goes to them, they don't exist anymore online. We had those removed. And also, the team identified more than 900 fraudulent advertisements on Meta, and we contacted Meta and had every single one of those taken down. So more than 900 of those ads have now been removed online. Operation CanCap didn't stop there. One of the important things we need to do in our collaborative work is share what we're learning about how these schemes are working, because they're complex. They have international organized crime figures behind them often, and they're constantly evolving. And so we in the enforcement community need to be in close contact with each other to say, here's what we found. We're working on this. Let's work together on this. Let's share what we learned on that so that collectively we're stronger and we have more capacity and capability to deal with these matters. We also, from CanCap and other matters, work closely with our investor education colleagues here at the ASC and at the CSA so that we share what we're learning from what we're seeing in these schemes and scams and frauds and other securities misconduct with our investor ed colleagues so that they can help to educate investors. And Kelly, do you want to talk about what we're doing in that regard?
Sure. Just very briefly, if you're okay, Samir. So recognizing time, I think collaboration is also critical. The information we get from enforcement is absolutely critical. So without a doubt, we do long-term programming and long-term partnerships. So we work with numerous different post-secondary educational institutions. We're working to find partners that get into the classrooms so that we can actually reach the kids that are in school. But where we started and where we had the quickest reaction was with post-secondary educational institutions throughout Alberta. So we go into the universities and the colleges, SAIT included, and others, Bow Valley College, and we do programs for students, programs for associations, So we're trying to reach people when they're at that age where they have a bit of money and they want to start. They're really excited about investing. So we do programs at just about every age you can think of, from really, we're trying to go younger, but 18 all the way up to in their 70s. Those programs are classes. Oftentimes they're virtual, they're through libraries, they're in numerous different communities throughout the province, up north, down south, Edmonton, Calgary. And we try to provide information on our website, which is checkfirst.ca. So not only the caution list that you talked about, but also investor alerts, enforcement information, enforcement activities that we've taken. So Check First is really meant to be a resource that we're going to continue to build out so that people can go there at any time. So that 24/7 resource really is available to people. But the exciting and the most, the things that get us so jazzed up is working with enforcement on that real-time disruption. Somebody mentioned that earlier. How do we get in there? How do we get into social media and act fast and get an information out fast? How do we get that out to the community, geo-target, use? I have some fabulous members on my team who really get technology and social media, and they're really trying to put the messages out there the moment or within at least a couple of hours when enforcement lets us know. So happy to say more, but I recognize we're short on time, so I'll pause on that front.
Yeah. Thank you.
That's great. Thanks to both of you. And I think it is important. One of the messages we're trying to deliver is we want to be interconnected with the CSA. We want to be interconnected inside the organization, but we also need industry to be involved, to help us disrupt. The more everyone understands, the better job we can do.
Can I just give one more example? Sorry, really quickly, talk about a collaboration. So we were excited to partner with the Edmonton Police Foundation and the Edmonton Police Service. We created, it was a Scam Shield challenge that went out to the innovation community to say, help us find or figure out another tool, right? It's gonna take, there's not one quiver that's gonna do, I don't think I'm getting my analogy right. Anyway, it's gonna take so many different tools, arrow in my quiver, that's right. It's going to take so many different ones. So help us come up with something unique and different. And we put it out to the innovation community through the Community Accelerator program. And we came back and we just a few weeks ago announced Stingray, which is an extension, a Chrome extension that people can download onto their computer that can help block these kinds of sites that Cynthia's talking about. So we're actually using those that are in the space to try to help us create new tools that are out there in the marketplace for people to use. And it was a collaborative effort from start to finish.
That's great. Thank you for adding that, Hillary. So I know we are tight on time. Cynthia, I was going to ask you, and I still will ask you, about what actions we've taken in the last year to hold bad actors accountable. But I'm going to ask you to say what's important about this case instead of these cases. You get one.
I get one.
Pick your bets.
Okay, I'm going to pick one. I will. Before I do that, I just want to launch off of Hillary's comment about the Stingray winner of the Scam Shield competition. It's an example when I talked about how every one of us in the room, where we are, what we can do. There may be others in this room right now sitting there thinking, I've got another technology idea, a different one that could help us fight. Great. Maybe someone's sitting there going, I'd love to help fund a project for someone to go off and do this. We need that. Our province and our country need that right now. So I get one case and I know it'll be quick. Okay, I'll choose. I'm going to cheat. I get 1.5 cases. Earlier this morning, there was reference made to finfluencers. I want to let you know that we have our first ASC enforcement decision out on finfluencers. The case is called Jaconomics. And this is why it's only my half case. I don't have time to give you the whole story on it, but essentially, securities laws say that if you are going to engage in paid investor relations activities on behalf of an issuer, both the promoter and the issuer have to disclose that fact. And we took an individual to task in Jaconomics where he was the promoter, he was the finfluencer online with the big following, and you know, he was showing videos of things like money falling from the sky, you know, you can get rich, look how easy it is, right? That wasn't his picture, I made that one, but I just wanted to give you a sense of the kind of things he was putting out there.
I really enjoyed the finfluencer dance.
Yes, this, yeah, it's kind of the money. What he didn't tell people, or in the few instances where he did, he buried it way down in the fine print, or a click through here for more information kind of thing, was that he was being paid. Well, Kathleen Rockwell mentioned this morning that disclosure is a cornerstone of securities regulation, and the disclosure of the fact that someone has a self-interest in what they're promoting is really important for investors to make informed decisions. That's my half case. Okay.
That was a big half.
Black box is the case I'll choose then. Black box is another case where a panel issued decisions in this year. It is a large-scale Ponzi scheme at its core. Why I want to tell you about this case is Ponzi schemes are nothing new, but it represents several things I was saying earlier. In really short form, this individual, Craig Thompson, who's from Alberta, through his companies, raised over $150 million from more than 1,000 investors in a span of 3.5 years. And he did it by telling people he was engaging in day trading on their behalf. And with a small number of the investors, he said he would engage in investor or invoice factoring. He did some day trading. He was not registered to do that. He did some day trading, about $20 million of the 150 that he brought in. He lost it all. That's not what he told investors. He sent investors weekly account statements showing that their investments were growing and growing and growing. Every week they were growing, which is how the scheme spread through word of mouth. So I don't know how many people in this room, if we were to put a challenge to you to say, can you go out there and can you raise $150 million solely through phone calls and word of mouth? Nothing else, no advisors, no advertising, no prospectuses, nothing else. I don't know how many people could do it. I can't. Certainly, I can't raise $150. But Craig Thompson did. He raised the $150 million, and it happened that fast. The scheme, the Ponzi scheme, collapsed as they inevitably do. Ponzi schemes have to ultimately. And when they do, there were hundreds of investors who lost absolutely everything. And for many of those people, that represented their entire life savings. It's devastating. The impact on individuals is devastating. That's $150 million that's not in our economy. In this case, a lot of the investors were in the US, but these are the kinds of schemes that are happening. This is good old-fashioned traditional fraud and traditional unregistered dealing, but it's happening at a speed and a scale at which we've not seen before. Why? Because things can spread like rapid fire through social media. I might have, I don't know, 10 friends in real life. I don't know what the number is, but you could have 5,000 online, right? You could have so many followers and contacts, and they have contacts. So even in traditional areas of securities misconduct, the harm is happening rapidly and at a magnitude we haven't seen before, as well as in things like the online scams that we're talking about.
But you held him accountable.
So we brought him to hearing, and the panel found he engaged in fraud and unregistered dealing things. It's like I forgot that part of the story. Yes, that they sanctioned him to roughly about $10 million total in penalties and disgorgement and the orders there. I will add that, because I've been asked this more than once since this case came out, why wasn't this prosecuted criminally? We brought the case through our regulatory system. At the time we first discovered what was going on, we immediately referred the case as well to the RCMP for criminal investigation. So we're able to pursue two different avenues so that we can focus on protecting investors as swiftly as possible and getting the word out and getting our decisions out, and also let the criminal criminal investigation run its course.
That's clearly two cases. That's not one.
You want to hear a third?
Nope. I know when you report the KPIs, I'll have to be a little more careful. I'll have to dig a little more into those. So we've got several questions here, and I'll see if we can get to all of them. I'm going to start with one kind of carries on from what you were just talking about, Cynthia. The question is, doesn't the money have to go through the banking system? Why? I think this means can't, not why can the banks shut this down, but why can't the big banks shut this down? By law, they must know the identity of the account holders. So perhaps you can speak to this. I know the banks have perhaps provided uneven work in this area. We may see some better than others, but maybe you can give a little more detail, Cynthia.
Yeah. So yes, even where we're talking about funds going through crypto, ultimately they need to end up through the traditional financial systems. I will say the banks are doing a fair bit. Everybody is being outpaced by what's happening, and the banks are facing their own challenges with it. Could they do more? Should they do more? I'll say yes. I'm not here to speak for the banks, but I'll speak on my own behalf and say yes, absolutely. We all need to be doing more. In that vein, the Canadian Anti-Scam Coalition was announced just in the last month or so, and that was orchestrated by the Canadian Bankers Association. They took the initiative in pulling together 30 different organizations and including social media platforms, Google and telecommunications providers and federal ministries and entities, federally regulated entities. So pulled the ball together to say what more can be done in this space, what more can be done through education, through technology, through prevention, through the financial system. So there's information available online about that Canadian Anti-Scam Coalition. And yes, we all need to do more. We all need to work together and do. Are the banks one of those opportunities to interrupt, to disrupt, to educate? Yes. And I spoke with one of their, the director of investigation for one of the banks, who said they struggle with clients at times who are refusing. The clients have been so hooked in and are trusting. They trust the person who's hooked them into the scam more than they trust their bank rep. And it's this, I've heard this repeatedly. And it really goes to how sophisticated these schemes are. So there are a lot of challenges and a lot of education and awareness and also institutional activity that needs to happen and reforms that need to change and laws that need to change.
Yeah, I think this goes back to the point we're trying to make, is that it takes a village to protect the villagers.
Yeah.
And, I think that's something that's important to, I hope everyone takes away from this is, we certainly take very seriously the part we can play and need to play, and we want to work with other people in the market and other people in the ecosystem who can help us drive down this fraud and keep that money in the legitimate industry and for legitimate investment purposes. Denise, I'm going to ask you to answer this one. It goes back to the semi-annual reporting pilot. With respect to the pilot to allow eligible venture issuers to voluntarily adopt semi-annual financial reporting, what would the ASC consider to be success in this pilot, and what risks prevent this from applying to all issuers?
Yeah, I think we're going to have to be looking at lots of different factors, sort of monitoring who's using it, because issuers will have to do a news release and announce that they're opting into that system. Who's using it? What type of companies? Is there any changes with sort of investor behavior and the trading and their ability to raise capital, to get a good sense of that pilot and how it's working. When we think about having it applied to all issuers, I think it gets it's something we may have to consider depending on what happens with the U.S. But I think there's other factors. So we've got the group that we're talking about it applying to it are venture issuers that really don't have an analyst following. It's largely retail investors investing them. When we start to talk about the larger companies that have sort of a quarterly news cycle, and they're holding calls with analysts and things like that, if we it's unclear whether they'd be interested in not having that quarterly reporting, and if they were to take it away, then what fills the gap? So do we end up with some sort of unclear interim reporting? So I think that one, it might be we're going to have to think about that a bit more and how that could work.
Okay, thanks, Denise. I think we have time for one more. So Cynthia, I'm going to come back to you on this one. It's in the disruption theme. The question is, I've reported phishing profiles on Meta and they don't remove them. How do you get social media to remove the scam ads?
Yeah, well, I can interpret this question two ways. How do we currently get social media to, or broadly, how are we going to get social media to do this, right? We've had some success, so if anyone wants to talk to me about specifics about how to go about it and whether we can support that, please do. Meta has a particular portal that you can send things to, but you have to do a fair bit of work on their end. If you ask me, what do we need? One of the areas of legislative reform we need in this country is federal legislation that holds the social media platforms, the online providers, accountable for policing their own sites. This is possible through technology. I shouldn't be and have staff who are going through to identify using technology that's available to these social media platforms, using technology to identify things that are clearly fraudulent, clearly a scam. We need to follow suit in other countries that have already gone this way and say that these platforms have a responsibility to monitor what's on their website and take out this harmful behavior. That's how we do it at scale. We can't, I share with you, we get 900 ads taken down. What's going to happen next week, right? It can't be a cat and mouse game. We need to be doing this at scale, and one of the ways we do it at scale is through legislative changes like that. So,
Excellent. Thank you, Cynthia. Okay, well, I think we're going to wrap it up here. I want to thank all three of you for the work you do at the ASC. I want to thank all of you for staying with us till the very end, although we're not quite at the very end. Stan is going to come up and share some reflections on the day. So once again, thank you all, and I hope the message resonates with all of you.